Hey, what's going on, everybody? I want to thank you for tuning in. I'm going to ask you that you like and subscribe and comment on this video. Today, we're going to talk about why you cannot look at stock prices in isolation to make investment decisions, because that's speculating more than investing. And I'm going to use Bed Bath & Beyond as an example as to why you cannot look at stock prices, because stock prices can be inflated for several different reasons. And so we want to look at how you have to look at the business and not at the price of the stock. All stocks are little pieces of businesses. So you have to look at how the business is doing and not what the stock price is doing. Because stock prices can fluctuate, they can go up, they can go down. But what's more important is always how is the business operating. So let's get into it. So Bed Bath & Beyond Chief Financial Officer Gustavo Arnault was found dead on Friday after falling from a New York City building, which was later termed to be a suicide. The lawsuit, which they were in, claims that Arnault and activist investor Ryan Cohen collaborated in a pump and dump scheme to artificially inflate the company's stock price. So with a pump and dump scheme, the individuals pump up the price of the stock so that they can be able to dump off the shares and sell them at a profit, so they can make a huge profit on unsuspecting investors. The lawsuit occurred less than 2 weeks after the executive was named in a federal class action lawsuit on allegations of federal securities fraud, insider trading, and breach of fiduciary duty, according to court documents. Now, a fiduciary is a person or organization that acts on behalf of another person or persons, putting their clients' interests ahead of their own. Now, it's been said that working with a fiduciary means that you can be assured that a financial professional will always be putting your interests first and not their own. This means that you don't have to worry about conflicts of interest, misplaced incentives, or aggressive sales tactics. Now, I'm not really a believer in titles like that. If someone is an honest person, they don't need a fiduciary title to do right by their clients. And if somebody is a crook or somebody who takes advantage of people, having a title of a fiduciary won't change who they are. So I don't get caught up in titles and say, well, this person is a fiduciary, so you know they're going to do right by their clients. You know, it only took me to the 4th chapter of Genesis to learn the true nature of man when Cain killed his own brother. People have a tendency sometimes to act in their own self-interest, especially when money is involved. So just because someone has a title does not mean that they're going to hold up to the ideals that title is supposed to represent. Think about police officers. How many times do you see police officers who are not doing what their title and what they're supposed to be doing, or priests or judges or whoever? So going forward, his death also comes just days after Bed Bath & Beyond announced it's shuttering 150 stores and slashing 20% of its corporate staff. Arnault is cited in the suit along with activist investor in GameStop. GameStop did the same thing in 2020. That and AMC and a couple of others became part of the meme stock, where the price shot up, possibly in the same aspect of it, where people were artificially inflating the price of the stock. So GameStop chairman Ryan Cohen, who the lawsuit claims collaborated with the CFO in a fraudulent scheme to artificially inflate the price of Bed Bath & Beyond's publicly traded stock. The defendants, knowing that the information that they disclosed was false, took advantage of the inflated stock price and used fraudulent and misleading SEC filings to sell all their Bed Bath & Beyond shares and options at artificially inflated prices to unsuspecting and innocent public investors, and then retain control of the profits, the suit says. On August 18th, both Arnault and Cohen sold shares of the company, with Arnault selling more than 42,000 shares for an estimated $1 million, and Cohen selling the entirety of his 9.8% stake through his firm, RC Ventures, causing the shares to plummet. The lawsuit claims Cohen, who is also the co-founder of Chewy and chairman of GameStop, approached the CFO about his pump and dump scheme in March of 2022 and convinced Gustavo that their plan would be a mutually beneficial one. Under this arrangement, defendants would profit handsomely from the rise in price and could coordinate their selling of shares to optimize their returns. Arnault allegedly worked with JP Morgan, which is listed as a defendant in the suit, on claims the bank aided and abetted the plan by enabling Cohen to use JP Morgan's accounts to effectuate such transactions and otherwise launder the proceeds of the criminal conduct. The lawsuit further notes Cohen's involvement in similar plans, such as elevating GameStop to meme stock status. Cohen has historically employed pump and dump schemes to raise much needed capital that has ignited several meme stocks to jaw-dropping heights, the lawsuit says. So this is one of the reasons where I want to talk about today why you cannot look at stock prices alone and make investment decisions, because the stock price or the price of the stock tells you absolutely nothing about the business. So you have to look to the business and how the business is doing and not look at the stock price. So on August 18th is when they sold their shares. If you look at the day before, August 17th, the stock price had gone up to a high of $30 per share. They sold their shares on August 18th. Then the stock price began to precipitously drop to $19, $11, $9. So it dropped by 40% in one day, but they had already taken their profit. So they was gone. But the people the unsuspected investors who had gotten in thinking that, oh, this company is going up, let me get in now before it's too late, because of FOMO, which is fear of missing out. They want to get in on a company that's going up. They want to buy shares and try and ride the wave. Then they get burned. So now the price is $6.67. And some people might think like, well, it's $6, so the stock is cheap, so now is a good time, or buy the dip. So people got to get out of this buy the dip mentality. What you're looking to buying is you're looking at buying outstanding businesses, not buying a dip. You want to buy outstanding companies. So one thing I learned from reading Philip Fisher is that he said, don't buy a stock because it's cheap. Buy a business because it's an outstanding business. So if you're buying a stock just because it's cheap, then there's a possibility that you might get burned, because if the company goes bankrupt, and if and when the company goes bankrupt, then you'll have people coming in saying, see, that's why you don't buy a single stock, Bed Bath & Beyond, yada, yada, yada. You know, it was a great company. Nobody thought it was going to go bankrupt. But I mean, you have to be able to see this stuff when a company begins to go through this process. Now, one thing that I always look at, if you go to Yahoo Finance, you type in the ticker symbol and you click on statistics, that if a company has negative profit margin, negative operating margin, negative return on assets, and negative return on equity. I heard Warren Buffett say one time that you can never get rich over time owning a company that has 5% return on equity over a long period of time. So what do you think is going to happen with a company that has a negative 195% return on equity? So all these happen. Now, this is your assignment. You can go and look up these terms, get a notebook, write them in, so you can look at these and say, if these are negative, there's probably a good chance it's not a good company to invest in anyway. So you look at that aspect of it, and then you can actually go back and look at how the company has been performing, because a lot of people say, well, the company is having a bad year, and that's because, so they pumped the stock up and they did this because the company is having a bad year. Most of the times, companies don't just drop off the face of the map in just 1 year. Usually that's a ongoing process that happens. So if you look at just how the company has performed over the last 5.72 years, if you invested $10,000 in Bed Bath & Beyond, which is January of 2017, your $10,000 would be worth $1,864.94. So it's averaged a negative 25% rate of return over the last 5 years. This wasn't just a 1 year phenomenon. This has been going on for a while. So if you look at the company and how it's been doing over a long period of time, you recognize when you're investing, you're trying to buy shares, you're becoming a shareholder. Look, I have no idea what the stock is going to do or what the stock price is going to do. It can go from $6 up to $80 over the next couple of months. I don't know. I've seen some crazy stuff happen in the stock market. But what you're looking at trying to do is you're looking at trying to buy great businesses that are growing, not businesses because you think the stock is cheap, I can buy it when it's cheap and the price runs up and then I can sell it. That's speculating, that's not investing. So you want to look at buying great companies that can grow and your money can grow with them. Now, if you look at also over the 5-year period of how the company has been doing over the previous time, you can see the earnings per share, there's a decrease. It's not a 1-year thing that's going on with this company. This has been going on for a multitude of years. So if you did own the company a ways back or a while back or 5 years ago or 10 years ago, you can be able to see this coming and you could be able to get out of the company. The revenue sales, negative 17% from this year, negative 14%, negative 21%. So the annualized 5-year growth rate of revenue is negative 8.4%. So you can see cash flow, it probably went up here because of the meme stock, because when people are investing in it, the cash flow is going to increase because people are investing their money into the company. So the company has more company. But when reality sets in and you recognize that maybe it's not a great company and people start taking their money out, the cash flow, unless the company is actually growing its cash flow through the operations of the business. And if it's not growing from the operations of the business and it's just coming from people actually putting their cash flow into it, then that can affect the way everything else grows. All right, so you can look at the assets, 7 billion, 6.5 billion. So they were flat here and they've continued to go down. So I look at, okay, over the last 5 years, has the assets increased or are they decreasing? The equity of the company, 2.8 billion down to 174 million. And then you look at the cash flow statement. One thing I like about Charles Schwab, Charles Schwab, is that it's color coded. You know, black is good, red is bad. So if you look at the revenue, in 2018, the revenue or the sales was 12.3 billion. Then 2019, 12 billion, 11 billion, 9 billion. Does this look like a company that has been growing over the last 5 years? If you just look at, if you didn't know anything from a deep dive into the company, but if you just look at certain numbers and you can say, oh, this company is not growing. The operating income, 761 million, negative 87 million, negative 700 million. So the operating income has been negative for the last 4 years. The net income, negative, 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 negative. So if you look at these, for me personally, I don't want to invest in companies that are not growing. Look for the outstanding companies that are growing their revenue, that are growing their net income, that are growing their earnings, that you can plant your money in, you can plant your seeds in, that can continue to grow. And that just allows your money to grow without you having to do anything, without having to worry about. You can sleep well at night by owning great businesses. But if you're trying to speculate and hope that you can catch something where you invest your money and it runs up and you can sell it real quick, then that's a possibility that you might get burned. So as I always say, look for investing in outstanding businesses, which I think are the only type the investor should buy. You know, for the simple investors, people who manage money, they can do stuff like this. They can guess because they're not playing with their money. They're playing with your money. So they can lose money, because if they lose your money, doesn't matter, because if they make you money, they make money. If they lose your money, they still make money. So you got to look at you as an individual investor, look at buying great businesses that you can buy, that you can own for a long period of time. You can sleep well at night. Even in this market when stock prices are going up and down, if you own great businesses, you recognize that this is not going to happen forever. It can be another 3 months, another 6 months, another 12 months. I have no idea. But I know that by owning great businesses, when this passes, the great businesses are continuing to grow, and you can continue to own them, and you don't have to worry about trying to jump in and out moving from one stock to the next. Just own great businesses. Simplify investing. Try to make it as simple as possible. That's what I do. Looking at making it as simple as possible by owning great businesses and not jumping on different stocks and going from that particular standpoint. All right, so Bed Bath & Beyond, definitely a company that I have zero interest in investing in.